Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
All right, welcome out, everybody. Brand new
We're here.
Podcast, first episode. Ty, are you excited for this?
I could not be more excited for what we're doing right now.
Yeah, me too. Been a long time coming. We've been planning on this for the last handful of months, been talking about it, getting prepped for it, so we can start presenting this now today.
That's right.
And if you can't tell yet, I'm Ryan Robertson. That's Ty Hansen.
Yep.
He's the Ty part.
Me.
I'm the Rye part. And we've called ourselves the Finance Guys.
Ty and Rye the Finance Guys.
We're dubbing ourselves that, so.
That is right. Self-appointed.
Yeah. And, you know, for this first episode, we want to just introduce ourselves quickly. It's not going to be too long and boring. We want you to know a little bit about us. But then what we really want to focus on is going to be, what's the podcast about? What are we going to be talking about? We're going to give you some good tips, education. The topics, I think, will be really, really well worth your time. So hopefully we'll introduce that to you today, and you'll subscribe and want to follow us.
And the other thing, too, we're going to do what we're dubbing or calling the market minis.
Yeah.
Right? Mm-hmm. We'll be bringing those out as well, so watch for those. So the podcast there'll be more depth and more meat to the podcast. The market minis are just like, what the devil is going on this week?
Yeah, which we're going to do in today's, because, man, today is May 17th. So you'll probably be getting this later in the week as this first episode. So we're going to be bringing everybody up to date on the market so far. And we'll be doing that every week so that you can get a good sense of what we think we're seeing and what's really going on.
Absolutely.
So
absolutely.
Let's not waste too much time, Ty.
Let's roll. I'm ready.
Let's do this. You tell us a little bit about your background. Where are you from? What you do?
All right. And I only
why
get
should
2 minutes.
Anybody?
Ryan's
yeah. Why should anybody listen?
Ryan's
to you?
warned me. If I go longer than 2 minutes,
okay,
he's going to replace me on the podcast.
2 minutes. Ready?
All right.
Go.
Ty Hansen, born and raised here in Utah. Love to ski, love to climb, love to run. Right? I'm nuts, run marathons. And I've been doing advising for nearly 20 years. And bachelor's, master's, finance. I'm a geek, right? I love this. This is the stuff I love. Love it. I did my bachelor's, my master's at the U. Have an awesome family. And yeah, we have fun. And this stuff, what we're doing on this podcast, like you'll find out soon. I'm uber passionate about this. I love this stuff because it's just, I'm a geek and I enjoy talking about this stuff.
Yep.
You, on the other hand, are the more level-headed, like, people like you, I think, more.
You think?
So, yeah, absolutely. Huh. Why? Why are you so cool?
Yeah, well, just the way I was raised, I guess.
Yes.
But same place from Utah, a little bit further north than you. I actually went to Utah State, teeny bit of a rival, but I got my degrees in history and fell backwards into what we're doing.
And a bachelor's and a master's? You have a master's
in history. Yep. And then I got out of college, and you really put that to work in finance. So I've been working at it close to the same amount of time, 15 plus years, working on people's retirement accounts, investment accounts, real estate.
That's right.
And we came together maybe 3 years ago, close to 3 years ago, and we just, almost really hit it off.
We did.
We really hit it off.
Like Thelma and Louise.
It is funny because
Romeo and Juliet.
It is. Yes, exactly, and hopefully we don't all die both at the end.
Thing. Yeah, exactly. Yeah. None of that.
But all the things that we're going to talk about in this podcast, we're going to introduce today, kind of came together when we met because we'd both independently been doing a lot of this, and then when we met, the light bulb went off in my head where I'm like, oh my gosh, what you brought to the table to kind of what I had already been doing, I was like, oh, these things have to be together. And you were kind of going down this path and doing it yourself. I'm like, oh, this is exactly what makes the most sense.
It was a match made in heaven, brother.
Truly made in heaven. Ty and Rye, even the names.
Ty and Rye, it flows.
I mean, you couldn't write this script. Like, Hollywood could not come up with this script.
Yeah, what do they call it? Benifer? And whatever those Hollywood names were.
Yep.
Exactly.
Yeah.
All right, let's jump into the
do
meat.
it.
People don't care about us. They care
do
about
not care about us.
They're like, listen, monkey boys, make us some money. Jump in, make us some money. Okay.
Let's start off with the little market mini. Let's talk about that because as of today, we're talking Monday, May 17th. What we saw last week is kind of the culmination of the last couple of months, sort of bringing to the surface some of the issues that I think the market was feeling, being worried about, and obviously it's going to kind of be at the forefront moving forward. So bring us up to date, Ty. Talk a little bit about what it is that we're seeing.
Bring it in. Okay, and again, I'm on a time constraint here because I can chat too
Yes,
much.
you can.
Okay, so the two biggest fears in the market this year, the two biggest fears that the market has, are not the party affiliation of the president. It's not COVID.
Oh, this is not. You're saying what's not.
Not.
You're not saying what is.
I'm talking about what it's not.
Because you said what is the fear. Now you're saying what is not the fear.
I did, huh? Right. Okay.
Okay.
So it's not taxes, right? Now those things have a little bit of an impact.
Sure.
What it is, the two things that are impactful are inflation and interest rates.
Kind of tied together.
Right. A lot of correlation. Now don't get me wrong. Political impact, all those things they do play a role. So I don't want to say they don't, but here's the problem. So I'll give you a couple of quick examples. So long and short, year to date, markets are still up. We're still positive. GDP still growing, which GDP is important. Most of the market sectors are doing well, right? It's funny because we're kind of seeing the market sectors that are less sexy perform better, right? Like the energies, the industrials, the things
Finance.
that are they're boring. I call it the portfolio from the 1980s, right? There's nothing fun or sexy about it, right? Everybody wants tech, everybody wants tech to be doing well, but the reason that there's a lot of fear there again is so. Again, these two pieces, right? So there, and I'm not going to dive into all the nuts and bolts here. We'll do this on a different podcast. But so earlier, about a month or so ago, one of the biggest tax implications that hit the news was Biden talking about raising long-term capital gains rates, right? Long-term capital gains. So when you sell your investment, if you've held it for longer than a year, what are your tax implications? Right?
At certain levels.
And yeah, exactly. Now, and that can freak investors out. Now, here's the thing. So on that day, the markets dropped about 1%. The next day, it rebounded 1.5%. Seriously, it was like, I guarantee you, 99% of people listening right now, they really didn't even have any clue that happened. They may have heard about the taxation, but again, that's how much of an impact it had on the portfolios. Okay. Now, February, March. A lot of people felt some volatility in their portfolios. Why? So there's different measurements to look at on interest rates rising, right? I mean, there's the Fed rate, there's different bond rate, kind of where the S&P 500 is kind of a litmus test for the market. A lot of people talk about the S&P 500 being the market, even though really it's not, but that's what a lot of people look as a benchmark, right? The 10-year Treasury bond is the bond equivalent, right? On the bond side of the market. And that bond part rose. Percentage-wise, not a ton. It was the percentage change that was more important. Anyways, my point is, the interest rates were kind of rising on their own, right? Organically.
From historic lows.
And also the market. Oh yeah, from insane historic lows because they've been compressed, right? We've quantitative easing, the Fed buying and selling, producing more money, all that fun stuff the Fed does. It kicks it down. It pushes those rates down. So we know they have to come back up. And we're in a little bit of a precarious position in our market because of that. But anyways, long and short, that rate starts to rise. And since it's rising, investors start to freak out. Oh, crap. I got to sell. And here's the other reason, too. We had this conversation earlier today. This is, I think, why Bitcoin has had such a little bit of a fire behind it was because people are like, well, we can't really go to bonds because bonds are a bad investment. We're afraid of our equities. Where do we go, right? So people are, anyways, there's a whole lot to talk about that.
We'll get into that, Ty. Don't worry.
So we will, coming down the road. So people are freaking out about the bonds. So anyways, February, March, we see some volatility. We were seeing weeks where we sold off, 3 or 4%, things like that. things calm down into March, middle of March, February, April, all of a sudden, awesome. Really, really awesome. Because again, why? The rates had calmed down. Things are okay. Okay, now fast forward to last week. For people that looked at their portfolios last week, they were probably like, oh, crap. Monday, Tuesday, Wednesday. Oh, crap. Like, this sucks. So that wasn't interest rates per se. It was inflation, right? So a lot of volatility. Well, then what happens Thursday, Friday last week, we have a little bit of, in fact, I'm even going to look at the portfolios today. The markets have a little
Bounce
bit
back
So it ended up being a super bad week, right? And even today kind of started out a little bad, but we're even seeing the markets come back today, right? So things are calming down a little bit. Again, what has had the biggest impact on the market year to date? Interest rates and bonds. Interest rates and inflation. We're going to talk about more because there's a lot to unravel from this, but I think I want people to understand that like, let's get above the noise because there's so much noise. Oh, it's Biden. Oh, it's this. Oh, it's that. Oh, it's housing. Oh, it's short. Look, there's definitely a lot of factors here, but the two main things that you should be concerned about are those things, are interest rates and inflation. And we'll talk more about that down the road. And that's what these market minis will kind of turn into is podcasts that dive deeper. If you want to dive deeper and know what the devil is going on, these are some ideas we're going to kick around. So that's the market. But on the year, I will say though, on the year, we're still positive. We're still trending in the right direction. Our economy's doing well. Unemployment's coming down. And anyways, there's a lot we're going to dive into because there's some pretty key pieces to this that I really want people to understand that we're seeing that, again, it's not noise. It's not stuff you're going to hear about on
it's not reactionary.
Exactly. It's not clickbait. So that's what we're seeing in the markets. Like I said, I'll go ahead. I'll even go so bold, Ryan.
Ooh, bold.
I'm going to go a little bit bold.
Put
here.
it on the
I'm
record.
going to go bold here. I'm wearing my goat shirt, right? So I'm gonna play the role of goat here, right? Greatest of all time. I don't think that I'm the goat, but I know I look at the markets a lot. I would be so bold as to say, if inflation doesn't go crazy this year, and if interest rates, both of those pieces can rise, but if they're very small proportionately, I am still very optimistic that this year will show at least a 10 to 15% return in the market. Yeah. Now, obviously, I can't guarantee results. I'm not saying that. Past performance doesn't. All I'm saying is I think we're going to see a continued growth. Now, coming into next year, things get a little trickier. But I still think we're on a trajectory this year for some positive growth. I really do.
And that's the kind of the point of the whole thing is tracking it consistently, being able to kind of make sense of some of this information that comes in. Because, again, with inflation, is this sort of a short-term trend because of the influx of capital in everybody's hands? They're just spending it all. Or does this make a more long-term... Right?
Yeah.
So
you just and it's the thing. I'll put that little teaser there. You just said something very important, right? You did. Is this all just based off of stimulus money, or is this a real growth? And I've got some pretty interesting data to provide.
And again, that's how we'll be able to answer those questions as we go, because we also know in 6 months what we're saying today, we've got the liberty to change because the data changes. So.
Oh, we're going to talk about this here in just a second as to kind of the overview of what we're doing here. But this is active versus passive management.
Good segue.
Active.
Great segue.
Exactly. Look at me, podcasting.
Seriously,
like
you're a seasoned vet.
I'm just following your lead.
So that's kind of, again, leads us into some of these other topics that we really, really want to focus on and go much deeper into, spend a lot more time on. We're going to talk about things like, because one of the areas that we spend a lot of time on are retirement accounts. And we really specialize, for us at least, we specialize in self-directed retirement accounts, what I've termed the hybrid model. You created, I termed it, so I'll probably get more credit because I named it. Will. But the hybrid model.
It's like here's the thing. If you ask anybody, who was the first person up Everest?
Rupert Everett. What's his name? It's Sir. Sir Rupert Everett.
Edmund.
Edmund Hillary.
Edmund Hillary. Sir Edmund Hillary. Oh,
All right. I knew it was a British guy.
and you know what's even funny to prove my point? I can't even remember the Sherpa's name. I can't remember the Sherpa's
his name
but there
was
was
Sherpa?
the Sherpa dude.
It was Dave.
We'll call him Dave, but that just goes to show you, like, he wouldn't have made it without
Seriously.
his Sherpa guide, and so technically, but that's my point is, like, you're the Sir Edmund Hillary, I am the native
Rupert
Sherpa
Everett.
here, where I'm Rupert, I'm carrying all of your heavy stuff up this mountain.
Yeah.
Yeah, okay.
So this
Anyways.
whole idea.
Okay, Edmund,
Yes.
what's next, Edmund?
So the solo 401k, we talk a lot about that. And just a lot of it that we focus on comes down to how to utilize these retirement accounts, because there's just not a lot. There's nobody that will actually do what we do. And I know that sounds like a grandiose claim, but it's kind of true. This self-directed account.
I don't know. Yeah,
The hybrid.
Exactly. I don't know who. Exactly. Maybe even like into a Minotaur. So I don't know who. To my knowledge, and I could be wrong, I don't know of any other advisory firm, right? Because we're a registered investment advisor with the Security and Exchange Commission. I don't know of any other advisory firm that does it the way we do.
Which highly
But the
unlikely
point
it's
is,
anybody.
This is a powerful tool, man. Like, this is and this is the thing is, we're not coming on this podcast. Our whole point here is to educate and help people know more, like, cut through this noise, right? That's really what it is. But, and again, part of that understanding that noise is like, this tool is, from a taxation standpoint, from an opportunity standpoint, from a strategic planning standpoint, this tool opens up a whole lot of doors. And not only does it open doors, but we've worked on some ways to make it more efficient. So from a cost standpoint, and from a standpoint of making sure that you've got the right help along the way, so you don't mess stuff up. So Solo K, self-directed IRA, the model we have built is pretty cool. And again, we want to teach people how to use it.
That's going to be our. It's
make
going to be
people-
this probably second and third episode that we actually do. So this is the first one we'll do. The next two are really going to dive into that particular idea and how you can use your retirement accounts for not only stock and bond investing, normal stuff that you're used to, and self-directed efficiently, cost-effective, and efficiency in investing. It's pretty cool.
So I'll just give one
little
quick
tidbit.
I'll give away a
Ty's
little tidbit. I have a client who invested in a board game. Like, my family was playing Mousetrap yesterday. Stupidest board game ever.
That kind of is.
We were playing Mousetrap. But think about that. Mousetrap has been around for 800 years, right? Like, I think like the ancient Incans were playing Mousetrap. My point is, you want to be an investor in something like that. There's ways you can do it. I have a client that did, and his game that he invested in as a passive investor.
Yeah,
made some good money.
Only
Only the
powerful
tool
could have done it. So we'll talk about that. Here's the other part, and you allude to this.
Yep.
We start talking about markets, how we analyze markets. That affects the way that we manage the money in our portfolios, and it's this difference between active and passive management. And again, little teaser, you're going to have to listen to get all that information. But this active versus passive is really, really important because it allows us the flexibility to move with the markets as we see fit, rather than park it and let it go. Yep, we don't forget
it. Yeah, and that's the thing I would say is, understanding that concept in and of itself is really forward thinking, right? And that's what we want to help people understand is like how in this modern world. And I'm not just saying, like, how do we invest in this modern world? Like, should I buy crypto? Like, that's not what I'm talking about. I'm just talking about philosophically, how can we be more efficient, right? And that's what that we're going to talk about that. How can you become more efficient with because every dollar, in fact, people ask me all the time, like, oh, I only have X or I only have Y. And that's a wide range of dollars. You know what? I don't care how much money people have. I don't. What I care about is, are you growing your dollar? Are you being judicious with that dollar, right? And effective with that dollar. And that's the whole point is active, passive. It's like, let's talk about some philosophies that while they have a fundamental platform of financial theory, how with technology and information that's available, how can we be more nimble and more judicious in the market, right? So yeah, we're gonna, and there's pros and cons to both. We'll talk about what those pros and what those cons.
But really important to understand those concepts behind it, because as you use your accounts, you kind of get a sense for, oh, this is active, that's more passive.
Right.
What he's talking about is passive. Yeah.
Right.
It'll make a lot of sense with that.
Yeah, exactly.
So that'll be something that we get into. That one's fun. We're going to talk about annuities, type of stuff that I think some people are familiar with, but yet a lot of nuances, a lot of complexities with how to use annuities. What are they for? We have specific ideas about what we think they can be used for and how maybe the best ways to use them too.
Well, exactly. And that's and here's the thing too, is there's about 4 or 5 different variations of annuities. And I don't think, like, even if you talk to people that have invested into an annuity, and just so everybody knows, an annuity is an insurance company product, right? There's people that have them and they're like, I don't know what I have. You know what I mean? And that would be, to me, I would love it if people would understand even what they have. And this is the thing too, in my opinion. So I've been doing this, almost, technically over 20 years, but, there's certain pieces to the annuity that never even get addressed with as I've seen in clients' portfolios, and I'm like, well, why didn't they think about the payout rate, or even there's a couple of other pieces that are so pivotal into it. Like, why didn't you think it? Like, why didn't you know about this? And so, anyways, that's where we want to dive into that. I will say this too. With the annuity, there's a little, because again, this is the masters of finance geek in me, right? There's an Excel model I've built that I want to share with everybody. And the idea is, we want to generate money. We want to generate cash flows when we retire, right? We want to have passive income idea. The annuity, there's a really powerful way that you can build it if you build it right, to where it's in some instances comparable, if not even better, maybe than real estate. Now, and we'll break that down. Now, does that mean you should do one or the other? No, you should do both. But let's talk about how we can build a total separate source of income that is. So if I have income A, income B, and income C, I don't want those 3 incomes to be related in any way or shape or form. I want them to be totally separate. So let's show you how to build all these different cash flows in a very, very cohesive manner.
And that whole annuity section that we're going to really go through is really to break it down at a level that when someone brings that up to you, you know what questions to ask.
See, this is what's important. This is why Ryan is so important, because I ramble, and I get excited, and I start throwing around like Sharpe ratios and payout rates and stuff like this. And Ryan's like, if anybody has seen the movie The Big Short, great movie, really good depiction and explanation. So I love it. Throughout the movie, people jump in, like Ryan Gosling or other people, and they are like, look, let me tell you what this really means. And then you're like, oh, I get it now. That's Ryan. Ryan gets it. He's like, okay, he's like translating for when I get too geeked out. So that's why we're like Fire and Ice. We're such a good baby. Combo. We bring the steam, the heat.
Yeah.
Fire and Ice, right?
Steam. That's good. That's good.
Wow. Now people aren't listening to us anymore.
So beyond that,
okay.
Well, tax planning. We're not CPAs. Let's make sure we say that. Disclose that.
No.
But we can always talk about it. Plenty of tax strategies you can incorporate into it.
Right, exactly.
Social Security discussions.
Well, and that, so that's huge. In fact, that's one thing. That's one thing that I've worked on a lot with client. Thousands of client planning sessions and planning reports. I built these reports for them, and it's interesting because, like, understanding the timing of cash flows and how it relates to your taxes. Because the idea is this: it's like, okay, what type of investments do I want to use? Right? We look at these different things we can put monies into, but then we also want to look at what are the tax implications for each of those. And as you start to bring all of that together in one cohesive plan, that's where you're now not only having good returns, but you're what we call, again, this is geeky Thai speak, your tax equivalent yield, right? Like after I account for taxes, what did I
tax
really
equivalent,
return?
Yeah.
Tax equivalent yield.
TEY.
Right? So that's what I'm saying. We'll dive into that. TI. Yeah.
Your TI coefficient.
TI. Yeah. It's kind of like my name.
Yeah. Well,
Yeah.
and then you kind of get into even more of discussions about the actual plan, someone's individual plan, and what components need to be put into it.
Yep.
So we'll even go through some of the basics for that too.
What are the 5 biggest mistakes? Because you and I, we've talked to so many people for 20 years now. What are the 5 biggest things we've seen people do poorly, like mistakes they make? What are the 5 best things we've seen? Because I tell you what, I will tell you right now, there is a very, very, very common theme with people that, and guess what? It doesn't matter how well. I mean, to a small degree, like you can't have 10 grand and try and retire for the next 30 years. That doesn't work. But what I'm saying, it doesn't matter if it's somebody with 150,000 or somebody with $10 million. There still is a common theme that we've seen across the board for people that are successful. And it does not matter how much money you have if you're successful or not. It does not. Yeah. So those we'll talk about.
So beyond that, then you're going to get into things like real estate. Obviously, real estate's important. We both have good backgrounds in real estate too.
Right.
Helping people with not only what we've done personally, but what we've helped people look at, performance on properties.
Love real estate. Love it. And here's the point. Coming back to my earlier thought, this is what's so cool. Again, is our point isn't here to say this one annuity or this one stock or this one crypto or
There's
this
a lot that goes
no.
into it.
The idea is here's the universe, right? Here's the universe of everything you can invest in. Here is the good and bad of all of those. Let's take the good and kind of mesh all that good together to give you that's what we want to talk about. That's what we want you to understand.
Cryptocurrencies.
For sure. Cryptocurrencies. There's a lot to unravel there. Let's break down the blockchain. Let's break down, is this currency? Is it realistic? Like, how do we quantify it?
And honestly,
how do we do this?
What is it?
What the devil?
Nobody knows. Let's just all be real honest about it. Maybe 5 people know what it really is. We'll explain it.
Yeah.
We'll explain it. It's kind of like explaining quantum mechanics. Do you really understand it?
Yeah, I was just going to say,
yes.
The theory of relativity and
but at the very least,
time-space
we'll
continuum.
talk about it so that you can have a basis when you're, if you're putting money into
more educated.
What is it really?
Absolutely.
I don't know. I'm very excited about all the stuff we're going to go into. Every week we're going to do it. Because we like talking, we like interacting.
I am too.
And here's the other thing with this, for everybody that's listening. If you've made it this far, we're into it almost 30 minutes now. We're going to have the ability to interact with everybody. You give us comments. You give us questions.
Absolutely.
We'll address those. It'll help us to put together the type of podcast that you, the listener, wants. Not the one that Ty and I want. The ones that you guys want.
Exactly. Uncle Ryan's mailbag. Every week. Uncle Ryan's mailbag. He's going to dive into there, open the letter with his letter opener.
If you're like,
let's talk about what
Ty needs
what people
more base on his face if we're going to do YouTube videos. We'll have someone come in and put makeup on him.
We're going to put more makeup on.
That's what we'll do.
Right. Exactly. No, you bring up a good point. Just as a quick side note, so I've got a good friend of mine. She's a client of ours, really good friend of mine. We've been friends for a while. We're gonna have some guests on too. One of my clients who's done really, really well with his self-directed in real estate and had some, kind of gone some ups and downs. So we're gonna chat with him. And this other gal, I love it because she kind of comes to this where she's a really, really smart individual, but she doesn't understand the finance world. And so I love it. We're gonna kind of do a basic Q&A. So it's like, okay, Ty, how does this really work with, compensation to advisors? How does this work if I don't have an actively managed portfolio? Like, what do things look like?
It's going to be super
We're going to
fun.
hit all these things.
Maybe even bring in my
party time.
20-year-old who...
we need to, dude.
He's got his own Robinhood account and is trading on it. And maybe he'll give us some advice, Ty, you and I. Like...
Right. Yeah. About Bitcoin. Yeah.
We will.
The coinage. That's right.
A lot of topics we're going to go through.
Okay.
I know. So everybody that's listening, a couple things. You go to the podcast that you love, hit subscribe on that. You'll get it every week, which includes the little mini market update every week. So you probably get maybe 2 different episodes every week. One will be a couple of minutes. The other one will be a little bit more of a deep dive.
Yep.
Leave your comments, questions, and,
And you know, you know, I think people like watching like cat videos and stuff where like cats get stuck in things, and it's cute watching the cat try and get out, right? So I think people will enjoy watching me try and condense talking about the market into like 3 to 5 minutes in these market minis. Like people are going to be like, "Oh, let's like get a bag of popcorn and sit there and be like, all right, let's see if he can."
Yeah, running
can
some over-unders.
We're gonna put a side bets. Yes. We're gonna put a little clock up in the window too, and we're gonna see if I can keep. Yeah. What are the not parlays? What are those side bets called? Prop bets. We're gonna take prop bets as to whether or not Ty can actually talk
how many
about
times does
anything
Ty
in under
refer
5
to how
minutes.
much experience he's got?
Okay. Hey, come on. Now we have to establish credibility somehow.
So everybody listening, hit subscribe. Also, myprosperteam.com. That's our advisory firm. You can go there. The podcast will be on that, right? So you can go there. You can listen to the episodes.
Yep. You can link there. Oh, and we're also starting to develop our actual podcast. The site's not quite ready yet, but the you can still use the web link now. tyandry.com. TY and RY.
So the podcast will all be on there, obviously, but subscribe. That'll be the easiest way for you to get it, and leave your comments. Yep. Ty, you got anything else as the GOAT?
Awesome. Nope, we're good.
All right, man. Hey, look, everybody, appreciate your
you.
time. We really look forward to doing this. We're going to do it every single week. And subscribe to us. We'll be really excited to have you on board. Ty, thanks for your time, man. We'll see you next week. Bye.
All right, my man. See you, bud.
Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.